Welcome to This Explainer. Today, we're jumping right into the fascinating and, yeah, sometimes totally perplexing world of corporate taxation. We're going to follow Elise. She's a brand new tax associate on her very first day at a large public accounting firm. Her assignment? Well, it's navigating the surprisingly complex puzzle of auditing Premier Computer Corporation's tax return. We'll just call them PCC for short. They're a medium-sized, publicly traded computer manufacturer. And, interestingly, they just hit their first tax loss in years. It's Elisa's job to pin down their exact taxable income, and we're tagging along for the ride.
Now, to really grasp the challenge Elise is up against, we need to look at a question that literally makes headlines every single year. Are large corporations paying enough in taxes? I mean, according to a report by the Institute of Taxation and Economic Policy, 55 highly profitable companies, we're talking household names here, like FedEx and Nike, managed to pay absolutely $0 in federal taxes in 2020. So, how is that even legally possible when they're reporting massive profits to their shareholders? Is the system completely broken, or is it actually functioning exactly as designed? The answer to that mystery comes down to two totally different lenses of corporate accounting. On one hand, we have GAAP book income. That stands for Generally Accepted Accounting Principles. These are the financial accounting rules designed to give investors a really accurate photograph of a company's true economic profit. But on the other hand, we have IRS taxable income. This is governed by tax laws written by Congress. And here's the kicker. It's not just about collecting revenue. It's designed to actively incentivize or penalize very specific business behaviors. Because these two systems have fundamentally different goals, the profit a company reports to Wall Street almost never matches the income they actually report to the IRS.
To reverse engineer PCC's audited financial income into their actual taxable income, Elise is going to use this step-by-step roadmap. First, the corporate tax formula. 2, book versus taxable income. 3, permanent and temporary differences. 4, corporate-specific tax deductions. And finally, 5, reconciliation and Form 1120. Let's get into it.
Number 1 on the checklist, the corporate tax formula, the baseline rules. When you compare corporate taxes to individual taxes, a major difference jumps out right away. As individuals, we're totally used to figuring out adjusted gross income and agonizing over whether to take the standard deduction or to itemize. But corporations, they don't get a standard deduction. They also don't get itemized deductions or even that qualified business income deduction. For a C Corp like PCC, the formula is actually remarkably straightforward. It's simply your gross income minus your ordinary and necessary business deductions. That's it.
So, the really crucial point here is that once Elise finishes all the heavy lifting of computing PCC's final taxable income, the actual math at the end is practically a breeze. She just takes that final number and applies the flat corporate tax rate of 21% to determine the regular income tax liability.
Moving right along to sections 2 and 3, book tax differences, the reconciling act. To bridge the gap between GAAP and the IRS, Elise basically has to play detective. She starts out hunting for what we call favorable differences. You can really think of these as the taxpayer's best friend. A favorable difference requires a subtraction from the company's book income. It acts as a tax reducer, meaning it pushes the IRS taxable income lower than the reported financial profit, which, of course, ultimately shrinks the tax bill. Let's look at a real example from Elise's audit to see how this works. She finds that PCC earned $12,000 of interest from City of San Diego municipal bonds. Now, for Wall Street, that's real income that absolutely gets reported on the financial books. But Congress wants to encourage investment in local governments, so this specific interest is legally excluded from IRS gross income. Elise gets to just subtract this $12,000 straight from the book income. It's a brilliantly favorable adjustment for the company.
But on the flip side, we have unfavorable differences. And these are where the pain really sets in for the corporate taxpayer. An unfavorable difference requires an add-back to the book income. This drags the taxable income much higher than the financial profit that was reported to shareholders. While she's digging through the trial balance, Elise spots a massive unfavorable adjustment right out of the gate. On PCC's financial books, they recorded a $2 million federal income tax provision as an expense. Makes sense for accounting, right? But the IRS strictly forbids you from deducting your federal tax expense on your federal tax return. So Elise has no choice but to add that entire $2 million back to the taxable income. Ouch. Other common culprits in this category include entertainment expenses, which are completely non-deductible for tax purposes now, and business meals, which usually are only 50% deductible.
Next up, Elise has to categorize these differences. She needs to pit permanent differences against temporary ones. A permanent difference, like that 50% of the meals expense the IRS denied, well, that's gone forever. It never reverses. But a temporary difference is really just a matter of timing. Take warranty expenses, for instance. For book purposes, companies estimate and deduct warranty expenses right when they sell a product. But for tax purposes, the IRS makes you wait until you actually incur the cost to fix the broken item. Eventually, both systems deduct the exact same total amount. It just happens in completely different years.
Now for Section 4 on the checklist, corporate-specific tax deductions, navigating the traps and opportunities. A really prime example of the complexity here comes from stock options. They create these massive, volatile book tax differences that totally depend on the stock market. For non-qualified stock options, a company gets a tax deduction equal to the bargain element, which is just the difference between the stock's market value and the exercise price when an employee cashes in. Just look at this wild swing from Meta. When their stock price soared in 2021, they got a massive $1.13 billion excess tax benefit. Huge, right? But watch what happens when the market turns. When their stock plummeted in 2022, Meta literally owed about $1.5 billion more in taxes simply because their stock price dropped, which completely wiped out that specific tax deduction. Let's look at another major corporate tax feature to see how this all builds up. Net operating losses, or NOLs. Remember how we mentioned PCC had a rough year recently? Well, Elise finds that PCC generated a $24,000 net operating loss from the previous year. Because it's a post-2017 loss, the tax code actually allows her to carry that loss forward indefinitely. She can use it to offset up to 80% of the current year's taxable income. This acts as an incredibly valuable temporary favorable difference. It's basically a way of smoothing out the tax burden for companies that go through these cyclical boom and bust years. Next, Elise tackles the dividends received deduction, usually called the DRD. This exists to mitigate the inherent unfairness of triple taxation. Think about it. A corporation is taxed on its earnings, then it pays a dividend to a shareholder corporation, which is taxed again, and then they distribute it to individual shareholders who are taxed a third time. Rough. To fix this, Elise uses a three-step formula. Say PCC received a $30,000 dividend from a tiny stockholding they have in Apple. Because PCC owns less than 20% of Apple, Elise determines they qualify for a 50% deduction. That creates a permanent, favorable book tax difference of $15,000 that just drops right off the IRS tax return. And that brings us to Section 5, Reconciliation and Form 1120, bringing it all together. This right here is the climax of Elise's audit. Let's look at the actual front page of Form 1120. This is the master document. Elise inputs the gross income up at the top, lists out all the tax-allowed deductions like depreciation and salaries in the middle, and then subtracts the net operating loss and the dividends received deduction at the bottom. By following the IRS rules to the letter, she officially arrives at PCC's final taxable income. Then she applies that flat 21% rate, which results in a total tax liability of $1,180,557. And all of that meticulous hard work culminates exactly here on Schedule M1. This form is the ultimate proof of Elise's audit. It requires her to explicitly map out all those permanent and temporary differences to perfectly reconcile the financial book income on the left to the taxable income on the right. She inputs the unfavorable add-backs on the left column, stuff like the federal tax expense and the denied entertainment costs we talked about, and then the favorable subtractions on the right, like that tax-exempt municipal bond interest. If her math holds up, the bottom line is going to perfectly match line 28 on the Form 1120. Now, while Premier Computer Corporation is a bit too small to trigger this next rule, Elise definitely makes a mental note for her future mega clients. And honestly, you probably should too. Because of those wild situations where giant companies pay literally zero taxes, Congress recently introduced the Corporate Alternative Minimum Tax, or AMT. Extremely large corporations, we're talking those averaging over $1 billion in income, are now watched very closely. If their book tax gap gets too suspiciously large, the IRS simply ignores the standard formula and slaps a 15% tax directly on their financial statement income, just to ensure they pay a baseline amount. Which leads us to the big picture. Why two systems exist? So as Elise wraps up her first day, we have to ask, why does this dual system even exist in the first place? Well, financial gap accounting absolutely must report the unvarnished economic reality to shareholders. But Congress,
They use tax accounting as a massive lever to guide the national economy. Now that you understand exactly how and why highly profitable companies can legally shrink their tax footprint through all these favorable adjustments and specialized deductions, we're left with a truly fascinating debate. Should Congress rewrite the tax laws to simply mirror financial book accounting, effectively forcing companies to pay tax on exactly what they report to Wall Street? Or would doing that completely destroy the government's primary ability to shape, incentivize, and guide the national economy? It is a complex puzzle, and it's one that tax associates like Elise are going to keep solving every single day. Thanks for joining us on this explainer, and keep questioning the numbers.